By the time we reach February, many traders are already asking the same question. Why does the market suddenly feel different? Now, January often comes with much broader narratives. It could be New Year optimism, positioning resets, seasonal effects around year end, but February does tend to behave very differently. And the primary reason is simple, because earnings season takes control of price action. And today I want to explain to you how earnings seasons changes markets behavior and why February trades often look much messier than January, and why seasonality becomes much more conditional during this phase. So the reason February is different is that the fourth quarter earnings season in the US is now really approaching its peak. And a large proportion of S&P 500 companies report their results late January, early February each year. It's major tech firms, financial and industrial firms just dominate the calendar. And what happens is markets transition from broad macro expectations to company level reality. And so the market focus is shifting from broad, large themes to specific company outcomes. That shift alone is largely responsible for the difference in price behavior that we see. And one of the most widely reported features of earnings season is just an increase in volatility. This is regularly discussed, coverage from financial media outlets every year. You'll see earnings surprise results in double-digit gains or losses. Why is that? It's because the earnings introduce binary outcomes, forward guidance surprises. It could be forward-looking uncertainty. So prices are no longer reacting in stock markets to general sentiment, but to whether expectations were met, missed, or surpassed. And this just naturally leads to sharper single-day moves, faster repricing, less smooth price trends, and that's why February can often feel much more erratic than January did. Now, another critical feature of earnings season is dispersion. And financial media frequently highlight that during earnings, some stocks rally sharply, others sell off aggressively, even within the same sector. So what happens is the markets stop moving together in synchronization. Now that's why stock pickers often thrive during earnings seasons, where index level trading just becomes much more challenging. Index performance starts to look a lot messier. You see here in February, this sort of sharp peak in the S&P 500 up to the middle of February, and then out of February, this much more challenging period you can see in the S&P 500. You also see in the Nasdaq this same kind of spiking behavior, very strong spike early February into the mid of February, and then a sharp move lower as well in the Nasdaq. So it just means that there's an important implication for seasonality. That seasonal patterns in the index, they tend to work best, when markets are moving in unison and together. When macro drivers are dominating, correlations can be very high between different instruments. But during earnings season, the opposite often occurs. Correlations can fail, dispersion rises, index averages can sometimes hide large internal moves. And that's why index seasonality tends to be lumpy in this sort of January, February, early March period. It's not that seasonality disappears, it just becomes subordinate to earnings events. Now, this is where the distinction matters, right? So for stock-focused traders, earnings seasons can create great opportunity. If you look here at Apple, you can see that coming out of mid-February into early March, there is a bias for selling in Apple stock. At the start of the month into mid-February, there's a bias for buying. Risk management becomes much more important, however, than prediction during this period, because you can see, look at the maximum gains, 12% to the upside, maximum 1% loss to the downside. But then as soon as we get through mid-February, you see that those falls can be as high as 22%, certainly have been over the last 10 years. So focus becomes much more on event risk and positioning. You can see here with Microsoft, again, this slow slide that you tend to see in the month of February into early March with maximum falls of 11.28%. You can just see that lumpy period showing up here in the January, February, March season. And you can see February tends to be one of the 3 months in Microsoft where you tend to see some downside, obviously influenced by earnings surprise. Tesla, again, tends to see significant downside in the month of February into early March. You can see February and March tend to be very weak months of the year, certainly have been for Tesla over the last 10 years. So the key takeaway really is like not to avoid February, but just to adjust expectations. And earnings seasonality is about recognizing why trades are maybe less smooth, why averages can mislead, why patience and selectivity matters much more. And seasonality here really helps to explain that market behavior, so you can see what's actually going on underneath the hood, as it were. So February does trade differently from January because the market shifts from broad macro narrative to individual company evidence. And earnings season introduces volatility, dispersion, uneven price action, risk event gap, all of which can weaken simple index seasonality. And understanding that transition can help traders and investors avoid false expectations and align their strategy with the phase of the calendar they're actually in. So that's the real value of seasonal analysis, not predicting outcomes, but understanding conditions and seeing how historical volatility has operated in whichever instrument you're looking at in the past. Remember, don't just trade it, season exit.